what happens to your money if the United States can't pay its debts? Not just your American shares, your retirement savings, your cash, your mortgage, the value of your currency, even the price you pay for everyday goods, because American government debt sits at the heart of the global financial system. And if America ever defaulted, the consequences wouldn't stop at the US border. But there's another problem developing at the same time. America needs to keep borrowing enormous amounts of money, while some countries are actively trying to become less dependent on the US dollar. Japan, the largest foreign holder of US government debt, is dealing with rising interest rates and pressures in its own bond market. BRICS countries are trying to conduct more trade using their own currencies. Russia and Iran have strong incentives to bypass the dollar because of sanctions, and some international energy trade is already taking place outside the traditional dollar system. None of this means America is about to default, but it raises an important question. What happens if America needs the world to buy more of its debt at exactly the same time that some of its traditional buyers have less reason to buy it? And if the worst eventually happened and America actually defaulted, how could you protect your money? This video is for educational purposes only and isn't personal financial advice. Everyone's financial situation is different, so always consider your own circumstances before making financial decisions. And let's make something very clear. We're not predicting that America is going to default. And we're not predicting the collapse of the US dollar. The dollar remains the world's dominant international currency. US Treasury securities remain central to the global financial system. And there is currently no obvious replacement capable of performing everything the dollar does. But risk management isn't about predicting exactly what will happen. It's about understanding what could happen and asking what happens to my finances if I'm wrong. When you hear that America owes tens of trillions of dollars, it's easy to imagine one enormous unpaid bill. That's not really how it works. The US government regularly spends more than it receives in taxes and other revenue. The difference has to be financed. One of the main ways it does this is by borrowing money. And it borrows that money by issuing Treasury securities, Treasury bills, Treasury notes, and Treasury bonds. They have different maturities, but the basic principle is the same. An investor gives the US government money today. In return, the government promises to repay that money according to the terms of the security, normally with interest. So here's an important point to remember throughout this video. Treasury securities are how much of America's government debt is held by investors. When governments, pension funds, banks, or individuals buy Treasury securities, they are lending money to the United States government. This is another area where there's often confusion. China does not own America, and foreign countries do not own most American government debt. Most US government debt is held within the United States or within the US government system itself. But foreign investors still own trillions of dollars of Treasury securities, and those foreign buyers matter because America needs a deep pool of investors willing to continue financing its borrowing. So which countries hold the most? The largest foreign holder is Japan, not China. Japan currently holds roughly $1.1 trillion of US Treasury securities. The United Kingdom is next with roughly $940 billion, and mainland China holds roughly $630 billion. Why do they own them? Because US Treasury securities have historically offered something global investors value enormously: safety, liquidity, and confidence that they'll be repaid. This connects directly to the US dollar. The dollar isn't simply America's domestic currency. It is used throughout the global financial system. Central banks hold dollars as reserves. Companies use dollars for international transactions. Commodities are often priced in dollars. Banks use dollars for financing, and investors around the world buy dollar-denominated assets. That creates enormous international demand for dollars. And if you're holding large amounts of dollars, one of the places you can put them is US Treasury securities. This relationship has historically given America an extraordinary advantage. It has access to a huge global pool of investors willing to lend it money. But that advantage depends on one thing that can't simply be printed: trust. And this is where Japan becomes particularly interesting. Japan is America's largest foreign creditor through its holdings of Treasury securities. For many years, interest rates in Japan were extremely low. That gave Japanese investors a strong reason to look overseas for higher returns. US Treasury securities were one obvious destination, but conditions in Japan are changing. Japanese government bond yields have risen significantly, and Japan is dealing with its own enormous government debt burden and rising debt servicing costs. This changes the calculation for Japanese investors. Imagine you can earn almost nothing investing safely at home. Buying an American bond offering a higher return can look attractive, but now imagine Japanese bonds themselves begin offering significantly better returns. Suddenly, the American bond isn't automatically as attractive, especially because a Japanese investor buying US Treasuries also has to consider movements between the yen and the dollar. Japan doesn't need to sell every Treasury security it owns for this to matter. It doesn't even need to sell most of them. If Japanese investors simply decide to invest less new money in American debt, that potentially removes some demand from the Treasury market. This is one of the most important concepts in the entire video. Suppose America needs to borrow another $1 trillion. Imagine there are plenty of investors desperate to lend America that money. America can potentially borrow relatively cheaply, but what if fewer investors want those bonds? America still needs the money, so it may have to offer investors a better return to persuade them to buy. In other words, higher interest rates, and that's where the problem can start feeding on itself. Higher interest rates mean new government borrowing becomes more expensive. As existing debt matures and needs refinancing, some of that debt may also have to be replaced with more expensive debt. That means more government revenue is required just to service the debt, and money spent servicing debt can't simultaneously be spent elsewhere. This doesn't automatically cause a default, but it can make an already difficult fiscal position harder. At this point, you might be asking, America controls the dollar. Why can't it simply create more money to deal with the debt? And this is where things get interesting. The Federal Reserve can create money electronically and use it to buy financial assets, something we've seen through quantitative easing or QE. That doesn't magically make America's debt disappear. If the government owes $1 trillion, creating more dollars doesn't simply erase that $1 trillion obligation. But inflation can change something extremely important: what those dollars are actually worth. Think about a mortgage. Suppose you borrow $300,000 to buy a house. 20 years later, $300,000 doesn't necessarily represent the same purchasing power it did when you originally borrowed. Your debt is still measured in dollars, but inflation may mean those dollars are worth less. Governments can benefit from a similar effect. If a country has large amounts of fixed nominal debt denominated in its own currency, inflation can reduce the real value of that debt over time. The government still owes the dollars, but those dollars may be worth less. And that might sound like an easy solution. Why default when inflation can reduce the real burden of the debt? Because somebody pays the price. Savers, consumers, workers whose wages don't keep pace with inflation, and investors holding assets that don't keep pace with the cost of living. If money creation becomes excessive, inflation can rise and confidence in the currency can weaken. Imported goods can become more expensive if the dollar falls. Foreign investors may then demand higher interest rates to compensate them for inflation and currency risk, which creates another problem. Higher interest rates make future government borrowing more expensive. So reducing the real burden of yesterday's debt can potentially make tomorrow's borrowing more expensive. There's another side to this. Inflation isn't automatically bad for every borrower. Think again about your mortgage. If you have long-term fixed rate debt, inflation can gradually reduce the real value of what you owe. You borrowed yesterday's dollars and you're repaying that debt with future dollars that may have less purchasing power. But there's a catch. If your mortgage rate resets or you need to refinance, higher interest rates can overwhelm that benefit. So inflation can simultaneously reduce the real value of existing fixed debt, while making new debt much more expensive. That's true for households, and in a much more complicated way, it's relevant to governments too. Now we need to look at the other side of the equation. America needs investors to buy its debt, but some countries are also trying to reduce their dependence on the dollar. This brings us to the BRICS nations. The group began with Brazil, Russia, India, China, and South Africa, and has since expanded. These countries don't all agree with each other. They don't have identical economic interests. And despite some sensational headlines, there isn't currently a BRICS currency about to replace the US dollar. But some BRICS countries do want to conduct more trade using local currencies, and they don't need a new global currency to reduce their dependence on the dollar. If two countries trade directly using their own currencies, they don't need dollars for that transaction. One transaction means virtually nothing. Millions of transactions over many years potentially do, because less trade requiring dollars means less demand for dollars than there otherwise would have been. And there's another powerful reason some countries want alternatives: sanctions. The dollar's central position gives the United States enormous financial influence. Many international dollar transactions interact with the American financial system. That gives the United States considerable power to restrict sanctioned countries, businesses, and individuals from accessing dollar-based finance. Iran has experienced this. Russia has experienced it. But look at the issue from their perspective. If access to the dollar system can be restricted, you have a powerful incentive to develop ways of trading without it. Alternative currencies, alternative payment systems, digital settlement mechanisms, more gold reserves, and financial relationships that don't depend as heavily on American institutions. This creates an interesting feedback loop. Dollar dominance makes sanctions powerful, but using that power gives targeted countries an incentive to build alternatives. And if alternatives become more effective over time, sanctions themselves could potentially become less powerful. Russia provides an example. Following extensive Western sanctions, Russia accelerated efforts to develop alternative payment mechanisms. That includes its digital ruble. Russia has also experimented with cryptocurrencies and digital assets for international settlement. A ruble-backed stablecoin called A7A5 has been used as part of cross-border payment giant infrastructure designed to operate outside conventional Western financial channels. None of these systems comes remotely close to replacing the dollar. That's important, but they don't need to replace it completely to demonstrate the trend. The lesson is simply, when countries are restricted from using an existing financial system, they have a strong incentive to build another one. And now we reach one of the most important commodities in this story: oil. For decades, much of the world's international oil trade has been priced and settled in US dollars. This is often referred to as the petrodollar system. Why does that matter? Because virtually every major economy needs energy. If countries need dollars to buy oil, they need access to dollars. Oil-producing countries then receive those dollars, and some of those dollars can subsequently be invested back into dollar-denominated assets, including US Treasury securities. So the relationship can look something like this. Countries need oil. Oil trade creates demand for dollars. Oil producers receive dollars. Some dollars flow back into American assets. This isn't the only reason the dollar dominates global finance, but historically, energy trade has been an important part of the system. And the current conflict involving Iran makes this particularly relevant. China is by far the dominant buyer of Iranian oil. Iran has extensive reasons to avoid the US-controlled financial system because of sanctions. China also has strategic reasons for wanting more international trade conducted in its own currency. That has encouraged arrangements where oil and other trade can take place using yuan and payment mechanisms outside the conventional dollar system. Now, let's keep this in perspective. Iran selling oil without dollars does not mean the petrodollar has collapsed, and China's yuan isn't about to replace the dollar overnight. But imagine the trend becoming broader. What if more oil-producing countries become willing to accept yuan, or euros, or rupees, or direct settlement in their own currencies? Every transaction taking place without dollars is one transaction that doesn't automatically create demand for dollars. Again, the key word is gradual. This is where we need to avoid exaggeration. You'll sometimes hear claims that the petrodollar is the only thing keeping the US dollar alive. It isn't. The dollar's position is supported by several enormous advantages. America has some of the world's deepest financial markets. US markets are highly liquid. The dollar is deeply embedded in international banking and global trade. Treasury securities are widely held throughout the financial system. America has established legal and financial institutions. And there is another factor that's harder to measure but shouldn't be ignored: American geopolitical and military power. The United States has the world's most powerful military, a huge network of alliances and security relationships, and enormous influence over the international system. The military doesn't directly back the dollar, but confidence in a currency is partly about confidence in the country and institutions standing behind it. For decades, America's economic, political, and military power have reinforced each other. That has helped make American assets appear secure to governments and investors around the world. So oil being traded in yuan doesn't suddenly destroy the dollar, nor does one country deciding to hold fewer treasury securities. There is an enormous economic, financial, and geopolitical system supporting the dollar. But none of those advantages is necessarily permanent. Now let's put everything we've discussed onto one page. America has enormous government debt. Much of that debt is held through Treasury securities. America, therefore, needs investors willing to continue buying those securities. Japan is the largest foreign holder. But rising Japanese interest rates may give Japanese investors more reasons to keep money at home. China holds substantially fewer treasuries than it once did. Some BRICS countries want to conduct more trade in local currencies. Sanctions are encouraging Russia and Iran to develop alternative financial systems, and some energy transactions can take place without dollars. None of these things individually means America is heading for default, but they all raise the same long-term question. What happens if America needs to sell more debt while some traditional sources of demand want less of it? Potentially higher yields, which means higher borrowing costs, which means more money required to service America's debt, and potentially greater pressure on government finances. Now we reach the extreme scenario. First, default does not mean America suddenly has no money and closes down. A default occurs when the government fails to meet a required financial obligation when it's due. That might involve missing an interest payment or failing to repay maturing debt on time. It could happen because of severe financial problems or because a political crisis prevents the government from making payments it otherwise could have made. Either way, the immediate financial loss might not even be the biggest problem. The biggest problem could be trust. For generations, Treasury securities have been regarded as among the safest financial assets in the world. A default challenges that assumption. Imagine America defaults. Investors now decide US government debt carries more risk than they previously believed. Some demand higher interest rates. Some diversify part of their money elsewhere. Central banks reconsider how much dollar exposure they want. Countries already developing alternative payment systems accelerate those efforts. Demand for some US debt potentially weakens. America then has to pay even more to attract buyers. Higher interest costs put more pressure on government finances, which can create more concern about debt. That's the dangerous feedback loop. Less confidence, higher borrowing costs, greater fiscal pressure, potentially even less confidence. Again, this is the worst case scenario, not our prediction. So now we come to the question that actually matters to you. What happens to your money? In the immediate aftermath of a serious US default, financial markets could become extremely volatile. American shares could fall, but international shares could fall as well. Banks and financial institutions could face pressure. Bond markets could become volatile. Businesses might find borrowing more expensive. Consumers could face higher interest rates, and investors around the world could move rapidly between currencies and assets. That's why simply saying, I'll sell America and buy Europe isn't necessarily protection. A genuine American sovereign debt crisis could become a global financial event. And this matters even if you've never lived in the United States. Imagine you live in Britain, Australia, or New Zealand. You own an S&P 500 ETF. Suppose the American shares you own don't fall at all, but the dollar falls significantly against your home currency. When you convert the value of your American investment back into pounds, Australian dollars, or New Zealand dollars, part of your investment return may disappear purely because of the currency movement. The reverse can happen too. A stronger dollar can increase the value of your US investments when measured in your home currency. The important point is, when you invest internationally, you're often taking both investment risk and currency risk. This is where we need to avoid another mistake. The objective isn't to find the one asset that will make you rich if America defaults, because nobody knows exactly how markets would react. The better objective is financial resilience. and there are 5 areas worth considering. First, don't make your entire financial future dependent on one country. The United States has produced extraordinary investment returns, and American companies remain some of the strongest businesses in the world. This isn't an argument for abandoning them, but if virtually every investment you own is American, you have concentration risk. International equities can give you exposure to different economies, currencies, and business cycles. They won't necessarily protect you during the initial shock of a global crisis, but over the longer term, you're less dependent on one country's financial system. Second, know which currencies you're exposed to. Where is your cash? Where are your investments? What currency are your bonds denominated in? What currencies generate the earnings of the companies you own? Some international investment funds are currency hedged. Others aren't. Neither is automatically better, but you should understand what you actually own, because an investment can rise in price and still lose value when converted back into your home currency. Third, maintain an emergency fund. That might sound strange in a video discussing currency risk, but cash has an important job: liquidity. During a severe market decline, you don't want to be forced to sell investments at depressed prices because the car broke down or you lost your job. Cash may lose purchasing power during inflation. It isn't designed to maximize your investment return. Its job is to give you options. Fourth, look at your own debt. If a sovereign debt crisis resulted in higher global interest rates, heavily indebted households and businesses could become particularly vulnerable. Variable rate borrowing can become much more expensive. Mortgages can cost more when they're refinanced. Companies with large amounts of debt can struggle. Preparing for a debt crisis doesn't necessarily mean buying something. Reducing expensive debt and making sure you can withstand higher interest rates can itself be a form of protection. Finally, don't rely on one type of asset. Shares provide ownership of productive businesses. Bonds provide income and traditionally offer defensive characteristics. Cash provides liquidity. Property and infrastructure provide exposure to real assets. Gold doesn't depend on a government's promise to repay you and has historically been used as a reserve asset. Some investors also consider Bitcoin because of its limited supply, although its extreme volatility creates very different risks. None of these assets is guaranteed to protect you during a crisis, and that's precisely the point. You're not trying to find one perfect asset. You're trying to avoid having one single point of failure. So let's bring the preparation together. Diversify across countries, understand your currency exposure, maintain emergency liquidity, control your debt. Diversify across different types of assets. Notice what isn't on that list. Sell everything. Buy only gold. Put everything into Bitcoin. Abandon American shares, or try to predict exactly when the dollar will collapse. Because that's speculation. We're trying to manage risk. And here's perhaps the most useful question you can ask about your finances. Don't ask, what investment will make me rich if America defaults? Ask, what happens to me if I'm wrong? What happens if the dollar remains dominant for another 50 years? Your plan should still work. What happens if the dollar gradually loses some of its importance? Your plan should still work. What happens if inflation remains high? Your plan should still work. What happens if interest rates rise? Your plan should still work. And what happens in the extreme scenario where confidence in US government debt is seriously damaged? Your plan might take a hit. Almost everyone's would. But the objective is that your financial future survives. And we should put the risk into perspective. Replacing the dollar would be extraordinarily difficult. The BRICS nations don't currently have a single replacement currency. China maintains controls over its currency and financial system. The euro has its own structural challenges. Gold can't perform all the functions of modern international banking. Cryptocurrencies remain volatile, and the US financial system is enormous, liquid, and deeply embedded in global finance. The dollar has significant advantages. So this isn't a prediction that the dollar is about to disappear, and it isn't a prediction that America is about to default. It's about understanding something much simpler. Financial dominance isn't guaranteed forever. America's position at the center of global finance has been built over decades. The dollar remains the world's dominant international currency. US Treasury securities remain among the most important financial assets on earth. But America also has enormous government debt, and that debt has to be financed. Japan, America's largest foreign creditor, is facing rising interest rates and pressures within its own bond market. China has reduced its treasury holdings from historical highs. Some BRICS countries are trying to conduct more trade without dollars. Sanctions are encouraging countries like Russia and Iran to build alternative payment systems. Some international energy trade can now take place without using the dollar. And inflation can reduce the real value of government debt, but at a cost to purchasing power and potentially confidence in the currency. None of those things means America will default, but they're risks worth understanding, because if confidence in US government debt were ever seriously damaged, the effects could spread throughout the global financial system. You don't buy insurance because you know your house is going to burn down. You buy it because you couldn't afford the consequences if it did. Financial diversification works on the same principle. You don't need to predict a dollar crisis. You need a financial plan that can survive one. If you found this useful, subscribe to Practical Assets for more straightforward videos about investing, building wealth, and managing risk. It costs you nothing, but it really helps the channel.